In today's episode of the Daily Brief, I'll talk about two interesting stories. I'll first talk about the three forces shaping Indian autos this quarter, and then I'll talk about a quiet steel stock and rupees 4 crore payday. Welcome back to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host Akshara, and today is Tuesday, 10th February. Coming to the first story, India's auto sector looks to be confidently bouncing back. At least that's the sentiment expressed by the country's largest car maker, Maruti, who said,
Once again, I'm happy to share that the Indian consumer has demonstrated her true strength, and she's the one who's actually driving us. We are the ones to follow.
This optimism is not misplaced either. Volumes seem to have picked up across most parts of the automobile market, be it four-wheelers, two-wheelers, or EVs. In turn, factories are running at higher utilization to meet growing demand, and waiting periods, which had almost disappeared over the last year, are beginning to show up again. Perhaps after a long stretch of sluggish demand and uncertainty, the sector might finally be turning a corner. However, this wasn't a gradual improvement driven by rising incomes or a slow return of confidence. What we saw instead was a sharp, price led response that moved the entire system at once. And once that system started moving, it ran into very real constraints. That's the story we'll be dissecting in this episode through the earnings call of Maruti Suzuki, Bajaj, TVS, and Ather. There are three forces that have dominated all of autos, no matter four-wheelers or two-wheelers, and that's what we'll be looking into broadly. Before we dive in, we'd love to have you check Concall Monitor by Tijori. Our team uses it to track con calls as soon as they're released, speeding up research times and even generating a quick sector report. Do check it out if you're an active investor. The most important driver of this quarter was not marketing, new launches, or even macro sentiment, but price. Most Indian households buy a vehicle only when they feel financially comfortable enough to take on the commitment, and they're incredibly responsive to changes in price. That's why the recent GST reduction mattered so much. Maruti Suzuki captured the significance of this better than anyone else on their earnings call.
It is not common that the taxes are reduced by about 5 to 10% on items in a single stroke. Given the magnitude of this measure, it was expected to show some manifestation in terms of market growth.
Bajaj Auto was completely unambiguous about where the momentum came from.
The momentum, of course, was set by the GST rate cut, which sustained, and the momentum sustained itself beyond the festive.
A 5 to 10% reduction in the price of cars, which cost lakhs, is no chump change for the price conscious middle class Indian consumer. And this wasn't even temporary like a festive season discount or a dealer led scheme. This was a structural shift in affordability, making a purchase that was earlier postponed for months feel more doable now. What's important here is not just that demand improved, but how it improved. This was a price led response, and price led responses tend to be fast and broad. Premium vehicles benefited because the absolute price drop was meaningful. EVs benefited because they already sit close to the affordability threshold for many buyers. That's why volume growth showed up across two-wheelers, four-wheelers, EVs, and non-EVs almost simultaneously. So, due to lower prices, demand did come back. But at the same time, supply proved to be a huge bottleneck in more ways than one. See, auto manufacturing doesn't scale overnight. After all, plants have fixed capacities and suppliers work on forecasts. Many critical components come from a small set of specialized vendors. When demand jumps suddenly, the system doesn't adjust smoothly at all. Maruti's management, for instance, had to tighten their operational belts with overtime.
Fortunately for Maruti Suzuki, the demand is robust across the whole spectrum. We had to work on Sundays and holidays to meet the demand.
In fact, this shortage of supply causes some of the lowest inventory levels they've experienced recently. Automakers usually aim to hold several weeks of inventory across their dealer networks. For Maruti, though, it was mere days.
We clocked our highest ever retail sales of over 683,000 units in Q3 of this year. With this, we ended Q3 with a very low network inventory of just about 3 to 4 days.
This means that vehicles are being sold almost as soon as they arrive, and when inventory falls that sharply, waiting lists only grow. Here's Maruti again.
along with a healthy order book of around 175,000 vehicles.
So, the combination of ultra low inventory and a swollen order book tells you how demand has overtaken the system's ability to deliver in the short term. Now, this wasn't limited to passenger vehicles or factory capacity either. In electric two wheelers, supply constraint showed up in a more specific form. TVS pointed directly to a very critical bottleneck that we have talked about on the daily brief before: rare earth magnets.
And all of you know that we had some challenges on the magnets availability.
Without these magnets, EV production simply cannot scale and they can't be swapped out easily. They sit at the core of the motor, and if they don't arrive on time, the vehicle doesn't get built regardless of how strong demand is. Over the last few months, the global supply of certain rare earth magnets tightened, with China controlling most of the processing capacity. This stung Indian manufacturers who suddenly found themselves in an odd position. Customers were ready, factories were staffed, and a demand was clearly there. But one critical input was missing. For instance, Ather indicated that the disruption was largely behind them. Management clarified that while the magnet ban from China did impact sales in Q1 and Q2, there was no material impact from Q3 onwards, since the ban itself expired in October. As a result, Ather said its supply chain was now back on track. Meanwhile, instead of redesigning motors or waiting for supplies to normalize, Maruti chose an interesting workaround. Since they couldn't source magnets directly, they imported larger sub-assemblies where the magnets were embedded as a part of a bigger unit. In effect, rather than buying the magnet separately, they bought the entire assembly that already contained it. This kept production moving, but it wasn't free. Maruti pointed out that rare earth supply issues had a margin impact because importing larger assemblies is more expensive than sourcing individual components. The company absorbed that cost in the short term in order to keep vehicles flowing to dealers. That's why EV production, even in a quarter where demand clearly returned, has scaled fairly unevenly. Beyond demand, supply chains will truly shape how fast EV adoption in India can really grow. The complications didn't end here either. Rising input costs were quietly pushing back as well. See, auto manufacturing is usually sensitive to raw material prices. After all, metals sit at the heart of almost every vehicle. When prices of, say, aluminium and copper rise, the cost of making each vehicle rises with them. This quarter, that increase in costs arrived at exactly the same time as volumes returned. Now, higher sales help profitability because factories and other fixed overheads are largely fixed in the short term. When more vehicles move through the same plant, those fixed costs get spread over a larger base, reducing per unit costs. That alone can make margins look healthier even without any change in pricing. And this is what firms call operating leverage. But raw materials don't work the same way. If aluminium or copper becomes more expensive, every additional vehicle costs more to make. So, while higher volumes were pulling margins up, rising input costs were pushing them down at the same time. For now, the volume effect has been stronger. Companies sold enough units for operating leverage to offset a large part of the cost inflation, and that's why margins held up better than many feared. But naturally, this balance is delicate. If volumes slow while raw material prices remain elevated, there's nothing left to cushion the impact. The same cost pressures that are being absorbed today would show up directly in profitability. That's why, even in what looks like a strong quarter, management commentary carries an undertone of caution. This was a strong quarter for the auto sector, but not for the reasons people usually assume. More than anything else, the rise in demand was driven by a price shock. Lower taxes changed affordability, and affordability changed behavior quickly. While the demand response lifted fortunes across the board, it also exposed the limits of the system. Inventory collapsed, supply chains tightened, and EV production ran into very specific bottlenecks. And at the same time, rising input costs quietly ate into margins. For now, higher volumes are doing most of the work. They're keeping factories busy, spreading fixed costs, and masking a lot of the pressure coming from raw materials. That's why the numbers look reassuring today. But that also tells you where the risk lies. If volumes hold up, the sector will continue to look healthy. If they slow, even modestly, while input costs remain high, profitability will come under pressure very quickly. So there's no hidden cushion waiting in the system. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That is exactly what we do in Points and Figures, a weekly newsletter that we send out every Tuesday. Link is in the description. Coming to the second story. So imagine, it's a chilly Monday morning in December 2021 when your Telegram app pings. It's a notification from a channel called Intraday Trading Equity Stock. You've watched this channel for weeks. It's filled with sure shot buy calls with mouth-watering screenshots of green P&L statements. The newest message is typed in aggressive all caps. Buy call delivery. Unison Metals Limited BSE code 538610. Add 10,000 to 20,000 QYT at 52.70. TG 80 by 120. SL 45. So you look for the company Unison Metals Limited or UML. You see a boring industrial outfit based in an industrial estate in Vatva, Ahmedabad. They make stainless steel sheets and pattas. There's no news, no groundbreaking invention, no sudden surge in global steel prices, but maybe they know something you don't. What you don't see, however, is the cold, calculated machine behind that telegram notification. That is the machine unraveled by SEBI in a recent order. The regulator discovered a 15-day masterclass in deception that took place in December 2021, which manufactured over rupees 4.29 crore in illegal profit. Here's what happened. So, behind the story were three distinct groups of people. One, those who needed to get out of the stock at profit. Two, those who helped them get out. And three, those who provided the keys to the house. Now, there was a core circle in the middle of the web. At the center sat the Nada family, which held a massive 17.03% stake in Unison Metals. They had just seen their holdings quadruple for free thanks to a bonus share issue in October 2021. And they were now sitting on millions of shares in a stock, only there was almost no daily trading in those shares. If they tried to sell even a fraction of their stake normally, the price would crater. If they needed an out, they required thousands of buyers to show up at the exact same time so they could dump their shares without moving the price down. Now, for any buyers to appear, someone would need to get the word out to an audience. That was where the operators came in. Coordinating this program, the timing of the buy messages, as well as the flow of illegal commissions, was Jalaj Agarwal. On one end, the link between this enterprise and the Nada family was Shailesh Patel. At the other end was Arvind Shukla, who operated massive telegram channels like Sure Means Sure and Owner Intraday. He brought an audience of anywhere between 5 to 15 lakh, and he was the one who actually hit send on the messages that lured the public into the trap. We'll soon get into how they work together. So, a scam of this precision requires real-time data, and that's where the company insiders came in. They leaked the BenPos, the beneficiary position, to the operators, and this sensitive weekly list shows exactly who holds how many shares. We'll get into why this was important in a bit. So the plan was set in November 2021 at the Karnavati Club in Ahmedabad when Shailesh Patel made Jalaj Agarwal a proposition. The Nadas had to exit their massive stake in Unison Metals, and for that, they needed Jalaj's shadowy services. If the operators would manufacture a buying frenzy in the stock, in return, they would take a 13% success fee on every share the beneficiaries sold. Jalaj knew just the person, Arvind Shukla, who ran a series of popular trader groups on Telegram. The scheme was set. On December 6th, the first telegram message was sent out, and the impact was an electric shock which animated the hitherto dead stock. On the previous trading day, only 60 unique buyers had touched UML. On December 6th, that number jumped to 943. The messaging campaign continued with new buy prices sent daily, drawing more traders in. By December 15th, the frenzy reached its peak. Over 5,000 unique buyers had descended on the stock, clamoring for a piece of a stainless steel company they'd likely never heard of a week ago. Now, this market manufacturing was carried out with scary precision. On 7 of the 12 days when recommendations were posted, either the opening price or the day's high matched the Telegram target almost down to the paisa. What those new traders didn't realize, perhaps, was that while on one side the operators were pushing group members to buy UML at a specific price, on the other side, the sellers, the beneficiaries, were placing sell orders at that exact same price. The buying was being steered to a pre-decided level, creating the conditions in which the dumping could proceed profitably. For example, on December 14th, a recommendation was posted at 8:55 a.m. to buy at rupees 70.35. The stock opened at exactly rupees 70.35. Now, this wasn't a coincidence. That precision was only possible if the sellers were already waiting with their sell limit orders at that price. It was all scripted. So, how did the operators know that everything was on track? So, they got that data straight from the company in the form of leaked Benpost data. This was essentially data from the company's internal ledger. And SEBI found an Excel sheet operator's phone which showed they were tracking specific sellers from the Nada family. This confirmed that the dump was working and told them exactly what commissions they were entitled to. Now, the company insiders claim they shared this data because they were raising capital for a sodium silicate plant. SEBI investigators, though, saw through the ruse immediately. A simple data point shows how fishy it all was. Just compare the number of trades in November, the quiet period, and those in December, the scam period. In December, the volume exploded to nearly 7 times the November average. The price of the company's script surged 84% within that single month for a company with zero fundamental changes. And with that, in less than 1 month, the Nada family had pocketed rupees 4.29 crore of unlawful profits. The beneficiaries were happy. Their work was done, their shares were sold, it was time to pay the operators. But it wasn't that easy. Moving tens of lakhs in illegal commissions, a 13% success fee, through a bank transfer would be suicide. So they went old school and the cash was delivered off market. SEBI didn't know exactly how that played out, but it's clear that they had a creative system in place. The payee would send images of 10 rupee or 20 rupee currency notes as digital receipts. The unique serial number on that specific bill was the password. So if a courier showed up at a meeting and presented that exact note, the receiver knew they were who the bags of cash had to be given to. It was a Hawala style security layer implemented via WhatsApp. For all their care with currency notes, though, they were incredibly sloppy with their phones. When SEBI conducted its search and seizure in March 2022, all the evidence was right on the operator's device. In fact, SEBI found photos of physical calculators showing the exact math of the sums involved. Consider these images from December 15th. The first shows a calculation. 4,10,000 shares times rupees 73.85, which is the closing price, equals rupees 3 crore 2,78,500. Then the second step, rupees 3 crore 2,78,500 times 13%, which equals rupees 39,36,205. That was the operator's cut for just 1 day of work. Now, the scam may have been successful, but it was too loud to stay a secret. The moment the buy tip stopped, the price began to slide. Retail investors who had bought shares at rupees 80 could only watch in horror. Those buy messages, meanwhile, were deleted from those Telegram channels on the very day they were posted. Everything pointed to a pump and dump scheme trying to hide its tracks. And so, in March 2022, just a few months later, SEBI launched its offensive. It carried out search and seizure operations at homes of operators, finding a mountain of evidence. There were records of 49 calls between the Nada family and the insiders during the investigation period. Clearly, there was a high frequency communication channel during the dump. The paper trail also showed sensitive Benpost data moving from the company insiders to the operators. There were also the token images and the calculator screenshots we talked about before. And beyond that, there was the sheer weight of coincidences. The biggest, of course, was that the company directors' close friends, the Nadas, sold 80% of their holdings exactly when a Telegram channel with 15 lakh subscribers told people to buy. As was the fact that the Telegram target price matched the market and the sell order of the Nadas exactly on 7 out of 12 days. It all looked too suspicious to be random. SEBI had its case. SEBI ordered the guilty parties to disgorge all the wrongful gains they made, and the money they made in this scam will be remitted to the Investor Protection and Education Fund, or IPEF. This is over and above the monetary policies imposed for violating securities laws, which comes to another rupees 3.65 crore. So if there's one thing to take away from this story, it's this. Any tip you receive is almost never for your benefit. If somebody knew of a stock with explosive potential, they would not tell you. They would simply load up and wait. There's no such thing as a sure shot shared for free with 1.5 million people. If you're buying something based on a Telegram notification, you aren't an investor. You're exit liquidity. That's true of the market in general, and it's even more so in the world of low cap stocks like UML. Now, coming to the tidbits. Adani Energy Solutions secured long term funding from Japanese banks MUFG and SMBC for a 6,000 megawatt HVDC transmission corridor connecting Rajasthan to Uttar Pradesh and is expected to be operational by 2029. Coming to the next tidbit. Sweden's SAAB proposes the induction of its fighter jet in the Indian Air Force. As part of this deal, it's offering a technology transfer with 300 plus MSME suppliers in India, rapid delivery from the third year post contract to complement IAF's Rafale and Tejas fleet. Coming to the final tidbit. SEBI modified the order to trade ratio framework for algorithmic trading effect April 6, 2026, exempting orders within plus or minus 0.75% of last traded price and equity options within plus or minus 40% or plus or minus rupees 20, whichever higher, acknowledging market makers' role in liquidity provision. You can check out all the links in the description. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.